In the 1990s, Enron was hailed as the crown jewel of American innovation. The Houston-based energy giant was praised as a company of the future, a symbol of how brains' ambition and new ideas could reshape entire industries. Business magazines celebrated it as one of the most innovative corporations in the world. Investors poured billions into its stock, and its executives were treated like celebrities on Wall Street. To the public, Enron wasn't just a company, it was proof that the American dream was alive and thriving. But behind the glossy image of success, something far darker was growing. Numbers on balance sheets were twisted into illusions, billions of dollars in debt were hidden behind complex structures, and the very people who were supposed to uphold transparency were instead building an empire of lies. Employees believed their futures were secure. Shareholders thought they had found the golden goose, and the government trusted Enron's spotless reputation. Yet in less than a year, that empire crumbled to dust. What was once the seventh largest company in the United States collapsed in a storm of scandal, leaving thousands jobless. Billions vanished, and Wall Street shaken to its core. This was not just a bankruptcy, it was one of the greatest corporate frauds in history, a cautionary tale that still haunts America today. The story of Enron is not just about money, it is about power deception and the dangerous belief that some people are too smart to fail. The story of Enron begins in 1985 when two relatively unremarkable companies, Houston Natural Gas and Internorth, merged in what at the time seemed like just another corporate deal. At the helm of this newly created entity stood Kenneth Lay, a smooth-talking executive with a background in economics and government connections. Lay envisioned something far bigger than just another regional energy provider. He wanted to transform the way energy was bought, sold, and consumed in the United States. His vision came at a time of massive change. The U.S. government was deregulating energy markets, opening the door for private companies to compete in ways that had previously been impossible. For Lay, this was not just an opportunity, it was the perfect storm. Enron quickly moved beyond simply transporting and delivering natural gas. It positioned itself as a pioneer in the concept of energy trading, creating a marketplace where contracts for electricity and natural gas could be bought and sold like financial securities. Instead of just delivering power, Enron was promising to revolutionize how energy itself was valued. The idea was so new and exciting that Wall Street couldn't get enough. Analysts praised the company as a model of innovation. Investors lined up eager to ride the wave of this new financial frontier. By the early 1990s, Enron had grown into one of the largest energy companies in the country, its revenues soaring, its ambitions limitless. A key player in this rise was Jeffrey Skilling, a former McKinsey consultant who joined Enron in 1990. Skilling was sharp, confident, and obsessed with efficiency and risk-taking. He convinced Lay that Enron could go even further by turning energy into a kind of commodity to be traded on an open market. Under his influence, Enron created Enron Online, the first web-based platform that allowed companies to instantly buy and sell energy contracts. This move positioned Enron not only as an energy company, but as a financial powerhouse operating at the cutting edge of technology. Skilling became the architect of Enron's new identity, and employees began to believe they were no longer working for a utility company, they were building the future of finance. The cultural transformation inside Enron matched its soaring ambitions. The company fostered an image of brilliance and superiority. It was said that only the smartest and most ambitious people could thrive there, and employees were encouraged to think of themselves as revolutionaries rather than mere businessmen. The corporate offices in Houston reflected this confidence, filled with young, hungry executives who dressed sharply, talked fast, and believed they were unstoppable. Lay and Skilling were often portrayed as visionaries who had cracked the code of the new economy, and their company's stock price reflected that belief. By the mid-1990s, Enron shares became one of the hottest commodities on Wall Street, climbing steadily and creating immense wealth for those on the inside. Fortune magazine named Enron America's most innovative company, not once, but 6 years in a row. The company expanded into new ventures, water broadband, even international projects in India and South America, each pitched as the next great frontier. Though not all of these ventures succeeded, the image of Enron as an unstoppable juggernaut only grew. For investors, it seemed like the company could do no wrong. For employees, it felt like they were part of something historic. And for Lay and Skilling, the empire they had built was the ultimate validation of their brilliance. Yet beneath the surface, cracks had already begun to form. Enron's rapid rise was not supported by the same level of tangible profit. Many of its flashy ventures were losing money, but clever accounting and aggressive public relations kept the illusion of constant success alive. On the outside, Enron appeared to be a shining example of American capitalism at its best. On the inside, the seeds of its downfall had already been planted. As Enron's reputation as the most innovative company in America grew, so did the pressure inside its glass towers in Houston. Employees weren't just told to perform well, they were told they had to be the smartest people in the room. That phrase, repeated constantly in meetings and hallways, became a kind of corporate mantra. It wasn't enough to meet expectations. You had to outthink, outmaneuver, and outshine everyone else. Those who couldn't keep up were swiftly pushed out. Enron's culture was built on relentless ambition, where success was rewarded with promotions, stock options, and lavish bonuses, while failure meant exile. For those inside, it was thrilling, but also terrifying. Jeffrey Skilling was the architect of this ruthless environment. He believed that Enron could not only trade energy, but transform itself into a kind of Wall Street powerhouse, moving money and contracts at lightning speed. To make this vision work, Skilling championed a controversial accounting method called mark-to-market. Under normal accounting rules, a company reported revenue when money actually came in. But with Skilling's method, Enron could book the entire expected profit of a deal on the very day it was signed, even if the money would not arrive for years or might never arrive at all. This meant that a contract predicting millions in future revenue could instantly appear on Enron's balance sheet as profit, giving the illusion that the company was flush with cash. To Wall Street analysts, this was dazzling. The numbers seemed almost magical, rising quarter after quarter with breathtaking consistency. Enron appeared to have found a formula for endless growth, and investors ate it up. But inside the company, employees knew that much of this profit was little more than wishful thinking dressed up as reality. Deals were signed not because they were good business, but because they could be spun into short-term numbers that impressed shareholders. The culture of rank and yank made the environment even more cutthroat. Employees were constantly evaluated and ranked, and those who didn't make the top 15 to 20% were fired. This system pushed workers to take risks, exaggerate results, and sometimes outright fabricate numbers just to survive. Managers encouraged employees to get creative with financial models, rewarding those who could make even the weakest deals look like spectacular wins. If a project failed, it could be buried under layers of accounting complexity, while the paper profits were still celebrated. In this environment, deception wasn't an accident, it was a survival skill. Skilling's charisma and confidence only added fuel to the fire. He convinced not just his employees, but also investors and the media that Enron was on the cutting edge of the new economy. He spoke of Enron as if it were a tech company rather than an energy business, aligning it with the booming dot-com era. His message was simple. Enron wasn't bound by the old rules of business, and anyone who doubted him simply didn't understand the brilliance of his model. Wall Street loved the story, and Enron stock continued to climb. By 2000, it had become one of the most valuable companies in America. Meanwhile, Kenneth Lay played the role of statesman. While Skilling was the aggressive visionary, Lay was the polished, politically connected face of the company. He maintained close relationships in Washington, particularly with figures in both the Republican and Democratic parties, ensuring that Enron had influence where it mattered most. With Lay reassuring the public and Skilling driving the aggressive growth, Enron looked unstoppable. But beneath the celebration and soaring stock price, the cracks were widening. Mark-to-market accounting was turning into a monster that required constant feeding. Every quarter, Enron had to find bigger and bolder deals to keep up the illusion of endless profit. The pressure to perform became unbearable. Executives began to rely more heavily on financial tricks using off-balance sheet structures and shell companies to hide debt and inflate earnings. The atmosphere inside Enron was electric but toxic. Employees lived in constant fear of falling behind, while executives strutted around as though they were untouchable. The company headquarters became a theater of arrogance, with young hotshots driving luxury cars, speaking in financial jargon that even seasoned analysts couldn't understand, and sneering at anyone who questioned their methods. Success was measured not by real-world impact, but by how high the stock climbed. And as long as the numbers looked good, nobody wanted to look too closely at how they were achieved. Enron had successfully built a culture where illusion was reality, and reality was ignored. Its executives weren't just fooling outsiders, they were fooling themselves. Convinced that their brilliance could bend the rules of business forever. What they didn't realize was that the very system they had created was unsustainable. The profits were fake, the risks were real, and the empire they were so proud of was sitting on a foundation of sand. By the late 1990s, Enron had become a Wall Street darling. Its stock price soared, its executives were celebrities in the financial press, and analysts repeatedly gave it glowing reviews. But behind the curtain, the numbers didn't add up. The profits were inflated, the debts were hidden, and the company was becoming more like a giant illusionist act than a functioning business. The man most responsible for engineering that illusion was Andrew Fastow, Enron's chief financial officer. Fastow understood that the mark-to-market system created enormous pressure to keep profits growing, even when the underlying business wasn't producing real cash. To make that happen, he began designing a web of entities known as Special Purpose Entities, or SPEs. On paper, these were separate companies. In reality, they were shells created to move Enron's debt off its balance sheet and to make bad investments disappear. Through these entities, Enron could transfer risky assets away from its official books and replace them with paper profits. Investors saw a company that was clean profitable and rapidly expanding. What they couldn't see was the mountain of debt that was being shoved into hidden corners. The complexity of these financial tricks was staggering. Fastow named some of the entities after characters from his favorite movies, such as the Chuko and Jedi partnerships. Each was designed with layers of accounting smoke and mirrors that made it nearly impossible for outsiders to follow the trail. Even seasoned analysts struggled to understand Enron's financial statements, but instead of pressing harder, many chose to trust the company's reputation. After all, Enron was considered one of the most innovative companies in America. Surely they thought it must know what it was doing. These tricks went beyond hiding debt. Enron would transfer assets back and forth between itself and the SPEs, booking profits on the transactions, even though they were essentially dealing with themselves. It was like moving money from one pocket to another and calling it income. In some cases, Enron even guaranteed the SPEs with its own stock, creating a dangerous loop where the appearance of profit depended on the stock price staying high. If Enron's share price dropped, the entire house of cards would come tumbling down. What made it worse was that the financial world seemed eager to look the other way. Banks lent Enron billions, fully aware that some of the structures were questionable, but unwilling to lose out on the lucrative fees. Credit rating agencies kept Enron's bonds highly rated, even as red flags piled up. And Arthur Andersen Enron's auditing firm signed off on the books year after year. Andersen not only audited Enron, but also earned millions in consulting fees from the company, creating a conflict of interest that would eventually destroy the firm. In effect, the entire system, auditors, analysts, bankers, was complicit in maintaining the illusion. Meanwhile, Enron executives cashed out. Skilling, Lay, and Fastow sold portions of their stock at high prices, becoming multimillionaires, even as they encouraged employees and small investors to keep buying. Thousands of Enron workers poured their retirement savings into company stock, convinced that their future was secure. Many were not aware that while they were investing their lives in the company, their leaders were quietly preparing an escape route. Inside Enron, the culture of deception only intensified. Employees were pushed to sign deals that made little sense simply because they could be spun into accounting profits. Risk managers who raised concerns were ignored or pushed aside. Those who questioned the numbers were told they just weren't smart enough to understand Enron's brilliance. In truth, what was happening was less brilliance and more fraud. By 2000, Enron reported revenues of over $100 billion, making it the seventh largest company in America. To the outside world, this was a triumph. To those who looked closely, the numbers were suspicious. Almost all of that revenue came from trading contracts rather than producing anything tangible. But the illusion was powerful, and most people didn't dare challenge it. After all, why doubt a company that Fortune magazine had honored year after year, or that politicians from both parties praised as a model of American innovation? The irony was that Enron had indeed pioneered something new, not in energy, but in the art of financial deception. It had mastered the ability to turn losses into profits, debt into assets, and lies into a story so compelling that almost everyone believed it. But illusions can't last forever. The more Enron leaned on Fastow's complex structures, the more fragile the company became. All it would take was a small crack in the facade for the entire empire to collapse. And that crack was coming sooner than anyone inside Enron was willing to admit. By the year 2001, Enron looked untouchable. Its stock price had climbed to more than $90 a share. Analysts were still praising it as one of America's most innovative companies, and its executives continued to live like royalty. But beneath that glittering surface, the empire was beginning to crack. The structures Andrew Fastow had built were growing more unstable by the day, and the company's reliance on inflated numbers had reached a breaking point. It was no longer just a matter of creative accounting. It was financial quicksand. The first signs of trouble came when skeptical journalists and analysts began to dig deeper. In March 2001, a Fortune magazine writer published an article titled, "Is Enron Overpriced?" The piece questioned how a company could report billions in revenue while generating so little actual cash. It was a bold challenge to a corporate giant that had long been praised without question. Inside, Enron executives brushed it off, insisting the journalists simply didn't understand the brilliance of their business model. But behind closed doors, they knew the spotlight was dangerous. The more people asked questions, the harder it would be to maintain the illusion. Then came a series of high-profile resignations. Jeffrey Skilling, the architect of Enron's aggressive strategy, abruptly stepped down as CEO in August 2001, citing personal reasons. To the public, the announcement was shocking. To insiders, it was a red flag. Skilling had been the driving force behind Enron's culture and accounting tricks. His sudden departure suggested that he no longer believed the facade could hold. Kenneth Lay stepped back into the role of CEO, but by then the damage was already spreading. Investors began to lose confidence, and the once soaring stock price started to slip. In October, Enron stunned Wall Street by announcing a massive third-quarter loss of more than $600 million, along with a $1.2 billion reduction in shareholder equity. For the first time, the hidden debts and risky partnerships created by Fasto were beginning to surface. The news rattled investors who had believed Enron's story of endless innovation. Questions about the company's financial health turned into panic as analysts scrambled to reassess what was really happening inside the Houston giant. The unraveling accelerated when the Securities and Exchange Commission opened a formal investigation into Enron's accounting practices. Suddenly, the shell game of moving debt into off-balance sheet entities was no longer a clever trick, it was a potential crime. Banks and trading partners, once eager to do business with Enron, started to back away. Credit agencies downgraded the company's rating, making it harder to raise cash. Enron's stock, which had once been a Wall Street darling, plummeted from over $90 to under $1 in a matter of weeks. The collapse was stunning not only in its speed, but in its magnitude. As the crisis deepened, employees watched in horror as their retirement savings evaporated. Many had invested heavily in Enron stock, encouraged by company leaders who promised a bright future. Now their life savings were gone almost overnight. At the same time, top executives had already cashed out millions of dollars worth of their own shares, insulating themselves, while ordinary workers were left with nothing. For many employees, the betrayal cut deeper than the financial loss. They had believed in Enron, devoted their careers to it, and trusted its leaders. To see it all disintegrate so quickly was devastating. By December 2001, Enron had no way out. Creditors demanded repayment, trading partners fled, and regulators closed in. On December 2nd, the company filed for Chapter 11 bankruptcy protection, marking the largest corporate bankruptcy in U.S. history at the time. More than 20,000 employees lost their jobs, shareholders lost tens of billions of dollars, and the American public watched in disbelief as one of its most celebrated companies crumbled into ruins. The shockwaves went far beyond Houston. Enron's collapse rattled Wall Street, raised questions about the integrity of corporate America, and shook public confidence in the financial system itself. If a company as admired and celebrated as Enron could fall apart so completely, what did that mean for all the other corporations investors trusted? Politicians scrambled to distance themselves, auditors scrambled to explain their failures, and ordinary Americans were left wondering how such a massive fraud had gone undetected for so long. The end of Enron was not just the story of a company failing, it was the story of a bubble finally bursting. For years, the illusion of brilliance had been sustained by ambition, arrogance, and deception. But when reality caught up, the fall was swift, brutal, and irreversible. What had once been a symbol of the American dream had become the ultimate cautionary tale of American greed. The collapse of Enron in December 2001 was more than a bankruptcy. It was a national trauma. Overnight, the company that had been hailed as the symbol of innovation turned into the face of fraud. For ordinary employees, the disaster was devastating. More than 20,000 workers lost their jobs, and with them, their health benefits and retirement savings. Many of those employees had poured their entire 401k plans into Enron stock, encouraged by executives who constantly reassured them of the company's strength. While workers watched their futures disintegrate, Top executives had already cashed out, securing millions for themselves. The anger that followed was not only about financial ruin, but about betrayal on the deepest level. Investors were equally devastated. Tens of billions of dollars vanished as Enron's once high-flying stock collapsed to pennies. Pension funds, retirement accounts, and small investors who had trusted Wall Street analysts and glowing media coverage suddenly found themselves with nothing. For many, it was a brutal reminder of how fragile trust can be in the financial system. The ripple effect spread across markets, leaving investors worldwide wary of corporate accounting practices. The illusion Enron had built didn't just vanish, it took confidence in the system with it. The scandal also destroyed one of the most prestigious names in the accounting world, Arthur Andersen. Once considered one of the Big Five auditing firms, Andersen had signed off on Enron's books year after year, despite glaring irregularities. When the truth emerged that Andersen employees had shredded documents related to Enron's audits, the firm's credibility collapsed. Convicted of obstruction of justice, Andersen lost its license to audit public companies, effectively putting an end to a century-old institution. The fall of Andersen was almost as shocking as Enron's own demise, a reminder that even watchdogs could be corrupted when money and power were on the line. For the executives at the heart of Enron, the aftermath was grim. Andrew Fastow, the mastermind behind the web of hidden entities, pleaded guilty to fraud and was sentenced to 6 years in prison after cooperating with investigators. Jeffrey Skilling, the aggressive visionary who had driven Enron's culture, was convicted of multiple counts of fraud, conspiracy, and insider trading. He received a 24-year prison sentence, later reduced, but spent over a decade behind bars. Kenneth Lay, the face of Enron and its longtime leader, was convicted on several counts as well, but before he could be sentenced, he died of a heart attack in 2006. To many of Enron's victims, Lay's sudden death felt like an escape from justice, leaving unresolved anger that lingered long after. Politically, the scandal forced a reckoning. Lawmakers could no longer ignore the gaping holes in America's corporate oversight system. In 2002, Congress passed the Sarbanes-Oxley Act, a sweeping reform designed to prevent another Enron. The law imposed stricter rules on financial reporting, increased penalties for fraud, and demanded more accountability from corporate executives and auditors. For Wall Street and corporate America, it was a turning point. Companies now faced far more scrutiny, and executives could no longer plead ignorance when fraud occurred under their watch. While critics argued the law created new burdens, its passage signaled that the era of blind trust in corporate leaders was over. Beyond the courts and the laws, Enron left a cultural scar. For many Americans, it became the ultimate symbol of corporate greed and deception. Documentaries, books, and even movies dissected the scandal, portraying Enron as a cautionary tale of arrogance run amok. The phrase Enron scandal entered everyday language, used as shorthand for corruption at the highest levels of business. College students studied it in business ethics classes, while politicians invoked it in debates about regulation and corporate responsibility. Enron was no longer just a company, it was a warning. Yet the lessons were not always fully absorbed. Even after Enron, other scandals followed: WorldCom, Lehman Brothers, the 2008 financial crisis. Each time, Americans were reminded of the same uncomfortable truth that when ambition, greed, and weak oversight collide, disaster is never far behind. Enron had not been the first, and it would not be the last. For the employees who lost their savings, the investors who lost their fortunes, and the public who lost faith in corporate America, the scars never truly healed. Enron had promised a future of endless innovation and prosperity, but what it delivered was a catastrophe that reshaped how Americans viewed business itself. Its dark legacy still hangs over Wall Street, a reminder that behind every dazzling success story, there may be shadows waiting to be exposed. The fall of Enron was not just the downfall of a single company, it was the unmasking of an illusion that had fooled the world. For years, Enron sold itself as the shining example of American innovation, a symbol of brilliance that promised to change the future. But when the truth emerged, it revealed something far more disturbing: a culture built on deception, arrogance, and greed. The collapse left behind wreckage measured not only in billions of dollars lost, but in lives shattered, retirements erased, and trust broken. For Wall Street, Enron was a wake-up call. Regulators and lawmakers scrambled to repair the cracks in the system, but the damage had already been done. Investors learned that glossy reports and soaring stock prices could hide a rot deep inside. Workers learned that loyalty to a company doesn't guarantee security. And the public learned that even the most celebrated leaders could be architects of fraud. The legacy of Enron is not measured in the energy it once traded, or the innovations it once claimed. It is measured in the warning it left behind. Today, Enron's name has become a cautionary symbol, a reminder that unchecked ambition can destroy even the mightiest empires. Its story lives on in classrooms, in boardrooms, and in the memories of those who lost everything. It is a lesson about the dangers of believing that brilliance excuses dishonesty and that some people are too smart to fail. Because in the end, Enron proved that when lies become the foundation of success, collapse is inevitable. And that is why the scandal of Enron still matters, not just as history, but as a warning for the future.